Welcome to our fourth learning objective of Chapter 2, where we are going to cover various examples of transaction analysis. We're going to apply the steps for transaction analysis to very simple transactions to gain a better understanding. But let's cover this transaction first. On July 1st, Joan Miller invests $20,000 in her own advertising agency in exchange for 20,000 shares of $1 par value common stock. First, we analyze the transaction. There's an increase in assets and an increase in stockholders' equity. We apply the rules. Debits increase assets, cash is the asset being increased. Credits increase stockholders' equity, in this case, common stock. And then we record the entry, a debit to cash, and a credit to common stock as of July 1st. It's step 4. We're going to post the transaction. First, we post the debit to cash of $20,000. Next, we post the credit to common stock of $20,000. And we're done with the fourth step. Let's move on to the next transaction. On July 2nd, we rent an office and pay 2 months' rent in advance for $1,600. Step 1, we analyze the transaction, increase in assets, and decrease in assets. Step 2, we apply the rules. Debits increase an asset, in this case, prepaid rent, since we're paying in advance, 2 months' worth, and we credit decreases assets, in this case, cash, since we are paying in cash for the rent in advance. It's step 3, we record the transaction, a debit to prepaid rent, and a credit to cash. Thereby an asset is increased, an asset is also decreased. Now we move on to step 4, where we post the transaction. First, the debit side, a debit to prepaid rent of $1,600 using T accounts. We post the debit, which stands for left, on the left side of the prepaid rent account. Then we post the credit to cash, $1,600, to the right side, meaning the credit side of the cash account. Okay, let's move on to a purchase transaction. On July 3rd, we purchase art equipment for cash, $4,200. We analyze during step 1 an increase in assets and decrease in assets again, and we apply the rules. Debits increase assets. In this case, art equipment is increased. Credits decrease assets. Cash is decreased. We make the recording. A debit to art equipment, a credit to cash, both in the amount of $4,200. Now we go to post it. Debit art equipment, $4,200, and credit cash, $4,200. Again, debit standing for left, credit standing for right. Next transaction. We order art supplies of $1,800 worth and office supplies, $800. We do the analysis. In this case, there's no entry because a transaction has not occurred. The act of placing a purchase order or making a verbal order does not result in a transaction that we would record in the accounting books. Next transaction. We purchase office equipment, $3,000. We pay $1,500 in cash and the remaining amount on credit. First, we analyze the transaction. We get an increase in assets and a decrease in assets and an increase in liabilities. So we apply the rules at step 2. Debits increase assets. In this case, office equipment is increased. Credits will decrease an asset. Cash goes down. Credits also increase a liability. Accounts payables increase. So at step 3, we record the transaction. On July 5th, we debit office equipment, $3,000. In exchange for the office equipment, we've paid $1,500 in cash, and we have agreed to pay another $1,500 at some point to the vendor in the future, so we credit accounts payable. Now we post it. Debit to office equipment of $3,000. Credit to cash of $1,500 and accounts payable of $1,500. Post both of those. Our debits equal our credits. We're in balance. We can move on. On July 6th, we purchase art supplies, $1,800, and office supplies of $800 on credit. Now we have an increase in assets and an increase in liabilities. If we apply the rules, art supplies and office supplies get increased. Liabilities, accounts payable, also gets increased. The idea here is that we're purchasing from one vendor. So we have two debits, one going to art supplies for the $1,800 representing additional assets that have come into the business. We also have a debit of office supplies representing an increase of $800 of office supplies, which are considered an asset. They have future economic value for the business. And the credit is to accounts payable in the amount of $2,600, the sum of the two amounts. Step 4, we post. We debit art supplies and office supplies, and then we credit accounts payable. And we're in balance, and we can move on. On this transaction, we pay a 1-year life insurance policy effective July 1st for $960. At the step 1, we analyze the transaction. We have an increase in assets and a decrease in assets. Step 2, we apply the rules. We debit the increased asset, which is prepaid insurance, and we credit the decreased assets, which is cash. Step 3, we record the transaction. Debit to prepaid insurance, credit to cash. Step 4, we post the transaction into the general ledger. We're using T accounts to illustrate the general ledger. We debit prepaid insurance, $960. We credit cash, $960, and we're in balance. Now let's take a look at a partial payment of a liability. On July 9th, we pay Taylor Supply Company $1,000 of an amount we owe them. We decrease liabilities and decrease assets. In step 2, we apply the rules. Debits increase a liability, a credit decreases assets. So at step 3, we can record this transaction. We debit accounts payable, reducing our liability by $1,000, and we credit cash since we have paid off $1,000 of what we owed to Taylor Supply Company. Now, when we post that, nothing new here. We debit accounts payable for $1,000, and we credit cash for $1,000. We're in balance. We can move on. Now let's take a look at some revenue transactions. On July 10th, we perform services by placing advertisements and we collect fees of $1,400. So here we have an increase in assets and an increase in stockholders' equity. Let's apply the rules. Debits increase assets, credits increase stockholders' equity. Now in this case we're in the advertising business, and the increase to stockholders' equity is actually the revenue account advertising fees earned. So let's record the transaction. We increase cash for $1,400, the amount we collected for the services we performed, and we credit a revenue account advertising fees earned, and revenue and expenses account all get summarized into stockholders' equity. Now we post that transaction. We debit cash of $1,400, and we credit advertising fees earned $1,400. And here you see that the advertising fees earned are showed in the section that relate to the stockholders' equity in the accounting equation. Let's take a look at an expense transaction. We pay secretaries 2 weeks' wages for $1,200. Decrease in stockholders' equity, which is the same thing as saying we have an increase in expenses, because increases in expenses eventually show up in the stockholders' equity section. And we have a decrease in assets. So in step 2, we apply the rules. Debits decrease stockholders' equity by increasing wage expenses, and credits decrease assets, in this case cash. So at step 3, we record the transaction. July 12th, wages expense, debit of $1,200, credit of cash, $1,200. We're in balance. Let's post the transaction. Debit wages expense, $1,200, credit cash, $1,200. So here as we post it, we see that stockholders' equity is decreased. At the same time, assets are decreased. Let's take a look at another revenue transaction. On July 15th, we accept advanced fee for artwork to be done for another agency. So this represents a payment received for future services. Step 1, we analyze the transaction. We have an increase in assets and an increase in liabilities. This is a little bit different. Let's apply the rules. Debits increase an asset, and credits increase liabilities. When we go to record the transaction, we debit cash for the $1,000 we received, and we credit a liability account, unearned art fees. It's a liability because it represents money we owe to someone else for work we have yet to have done. That means is if the business were to close right after they paid us the money, we would owe them the money back since we haven't performed the work yet. Therefore, unearned art fees shows up as an obligation of the company in the liabilities part of the balance sheet. Okay, now let's post that transaction. Debit to cash of $1,000. Credit to unearned art fees of $1,000. We're in balance. On July 19th, we perform advertising services for which payment will be collected at a later date, $4,800. So in this case, we've earned revenues, but we're not going to get our money until later. Let's analyze the transaction. We still have an increase in assets, and we have an increase in stockholders' equity because we did earn our revenues. We apply the rules. Debits increase assets. In this case, we're going to use the accounts receivable account. And credits increase stockholders' equity. Advertising fees earned. A revenue account that eventually flows to stockholders' equity. We record the transaction on July 19th by debiting accounts receivable for the $4,800 we are owed for the work we have done, and we credit advertising fees earned for the $4,800. Now let's post that transaction. Nothing new here. Debit accounts receivable, $4,800, increasing assets, and credit advertising fees earned, $4,800, which also increases stockholders' equity. Another way of saying that is it increases revenues, the advertising fees earned account. Let's cover another expense transaction. On July 26th, we pay secretaries 2 more weeks of wages, $1,200. Step one, let's analyze the transaction. This transaction represents a decrease in stockholders' equity. Another way of saying that is stockholders' equity is decreased because we had an increase in expenses, and we have a decrease in assets. Let's apply the rules. Debits decrease stockholders' equity by increasing wages expense, and credits decrease assets, in this case cash, we paid to pay for the secretary's wages. So on July 26th, we debit wages expense $1,200 and credit cash for $1,200. When we go to post this, it's a debit to wages expense and a credit to cash of $1,200. In this case, the automation did not follow very well, but we do get a debit to in the stockholders' equity, decreasing stockholders' equity, and a credit to cash, decreasing assets. On July 29th, we receive and pay a utility bill for $200. This represents a decrease in stockholders' equity and an increase in expenses and a decrease in assets. Let's apply the rules. Debits decrease stockholders' equity by increasing utility expense, and credits decrease assets, in this case cash. We record this transaction on July 29th with a debit to utilities expense and a credit to cash, both in the amount of $200. Now, when we post this, again, nothing new. Debit to utility expenses, credit to cash. We're in balance. We can move on. On July 30th, we receive a telephone bill. Now, what's important here is we're only receiving the bill. We're not paying it on July 30th. We analyze this and we say there's been a decrease in stockholders' equity, an increase in expenses, and an increase in liabilities. The act of receiving the bill usually is the point at which we will record expenses of the business, even though we'll pay them later if they were given to us on credit. So if we apply the rules, debits decrease stockholders' equity by increasing telephone expense, and credits increase liabilities, in this case, accounts payable. The entry, July 30th, telephone expense is debited for $140, and accounts payable is credited for $140. We post it by debiting telephone expense for $140, and we credit accounts payable $140, increasing liabilities and decreasing stockholders' equity. Let's look at a dividends transaction. On July 31st, the business declares and pays a dividend of $1,400. This represents a decrease in stockholders' equity and a decrease in assets. Debits decrease stockholders' equity, credits decrease assets. The entry is recorded with a debit to a dividends account, which is part of the stockholders' equity section, and a credit to cash, both in the amount of $1,400. When we post this transaction, we have a debit flowing to stockholders' equity to the dividends account and a credit flowing to cash, decreasing the cash account $1,400. Okay, we've come to the end. Why does Joan Miller Advertising Agency record the expense for the telephone bill even though it hasn't been paid? 3 reasons. An expense has been incurred for the telephone services used. In fact, whether or not we receive the bill, we probably need to record the monthly telephone services that we used. At that point, an obligation to pay exists. If the company were to go out of business, they would still own the phone. They would still need to pay off the phone bill for the services they used prior to going out of business. The company records the expense, and the liability